Welcome to Cash Talk, the podcast where we delve into the depths of finance, business, and life itself. I'm your host, John Cachia, a multi-award-winning wealth advisor with a passion for empowering ambitious Australians to confidently achieve financial freedom. Hey everyone, before we get started, this is a quick reminder that everything in this podcast is of a general nature and nothing has been tailored to your personal circumstances. So please seek personal financial advice before acting on this information. Hello and welcome back to Cash Talk, and today I'm joined by Amph. Amph, how are you, man?
Good, thanks. Yourself?
Yeah, not bad. I feel like I've been punching out a few episodes with you lately, haven't I?
Yeah, getting them all done before you go.
Oh, mate, got to get them out there before I go because I'm not doing these podcasts while I'm over there. No, to be honest with you, I actually love doing these podcasts. It's just having all the facilities over there. I might need to do it off my phone. Quality might not be as good, and there might, might hear some kids in the background. So might as well get them out while I'm away. Before I go away, sorry.
That's it.
But today what we're going to be speaking about is something that we look at all the time, and that's the essentials of investing. And there's a few things that we want to kind of go through today, which are really like staple kind of things that we look at when it comes to investing. So hopefully you get some really good insights from what we go through today. And, where do you want to start, Ants? Because there's a few like essentials when it comes to investing.
Yeah, I think I'll start with my favourite one actually, and that's dollar cost averaging. It's a really good strategy, or even a tool I like to call it, that we use for a lot of our clients, and it's really, I find it really effective, especially when you're just beginning to invest, when you're dipping your toes in, trying to understand how everything works. I find dollar cost averaging is a nice segue into investing, but also a really useful strategy if you're investing for the long term. Or even if you don't have all the money that you want to invest up front and you can only afford to start with something small, it's really useful.
Yeah, it's a really good like risk mitigation tool as well too. So, we're working with a client at the moment. He's in his late 50s, early 60s, and he's got a fair bit of money sitting on the sidelines. And we're actually doing a bit of a hybrid approach. So we're putting some money in as a lump sum, and then we're putting some money in like installments in dollar cost averaging over time. And this allows him to get kind of a bit of the best of both worlds, so that he's entering into the market, not with all of his money, with some of his money up front, and then in installments over the time. Now, it also, like Anthony mentioned, is really good from a behavioural side of things too, because when you're consistently doing something, it becomes habitual. And when it becomes habitual, it means that in most cases, people actually will continue that. And if you actually think about superannuation is a dollar cost averaging, like from your employer. So your employer, puts regular contributions into your superannuation, and that is a version of dollar cost averaging. And it's really, really good that the superannuation system was designed in a way where we can have regular contributions that go in, because as well too, it then starts to remove one of the main risks is timing risk. Okay, so if you enter all your money in one transaction on one date, well, markets could go down, they could go up from that date. So the importance of that timing is very important. But if you spread it over, you essentially get the average, as it says, over a period of time.
And for those of you who don't know what dollar cost averaging is, it's essentially like drip feeding your money to an investment over a period of time. So rather than putting a whole lump sum of money in an investment up front, it's putting an amount each week or each month, whatever sort of frequency you like, over a period of time to eliminate some of these risks, like you mentioned.
And like, I would say that we choose dollar cost averaging in most cases because we're focused on reducing the risk, and we wouldn't use it if it's going to be at the detriment of the person achieving the goal, okay? But if you can use it, it's going to lower the level of risk. Now, the problem that people have with dollar cost averaging, as much as it sounds great, it reduces risk, we can enter market over time. If you bought at, let's say, the bottom of a market, and then your money just happened to just skyrocket up, obviously it's going to be better to put all your money on that date. But the same can be said that it could be the opposite, is if you put your money in all on that one date and then the market tanks, That's what we're talking about in timing risk. So think about it. If markets are going down, you would enter at, month 1, month 2, month 3, month 4, month 5. So you go down. And then obviously if it's going up, it's going up the other way. But what you find is that markets move kind of a bit sideways, up and down and left and right, and it ends up smoothing over time. So in most dollar cost averaging, when you actually like run different scenarios, you'll see that the dollar cost averaging one is usually the smoothest line. So reducing therefore volatility, that's what it's trying to do. So dollar cost averaging, we use it in that case, but you lean towards that in most cases, yeah?
Yeah, because it's also a really effective way to integrate investing in your normal budget, like day-to-day budgeting. Like when we set up a cash flow plan, you're going to have a look, we got surplus cash flow, X amount goes to savings, X amount goes to investments. And if it's coming out every month and it's just built into your system, you've got like that split between, all right, we're putting X amount into savings, X amount into investments, and it's just automatically coming out. And it's like a seamless process because especially if you're new to investing, say trying to get 20, 30 grand out of your savings and put it into an investment account, it's going to scare a lot of people. So it's an easier way to, okay, we can minimize the amount that we put in up front, and then maybe over a 2-year period, we're able to invest that larger sum of money. But also, a lot of people might be in the situation where they don't really have that huge nest eggs. They've probably got enough to keep themselves comfortable, like an emergency fund, but they want to start investing and don't have that huge amount of money to start investing. Well, that's where dollar cost averaging works out well, because cash flow might be good and we might be able to save like, I don't know, $2,000 a month. And you might say, okay, let's invest $1,000 a month. Let's save $1,000 a month. And by doing that, you don't need to really postpone investing. You can start a little bit earlier and put in over a period of time.
So it's a really good insight, Anth, into how we use it, and one of the essentials that we go to. One of the other ones that we go to a fair bit is rebalancing. Okay, I was with one of the advisors today, and we were talking about a client about rebalancing. And rebalancing is that, let's say we have a bucket of money, okay, and let's say we'll make it 100 grand to make it simple, and we know that to achieve the person's goals, that bucket of money needs to be split up 50% in defensive assets and 50% in growth assets. And to make this for simplistic purposes, let's just call the defensive assets cash and let's call the growth assets shares. Now, in a bull market, or when the share market's doing quite well, okay, you'll find that portfolio, that 100,000, might have grown to say 120,000. But the $50,000 made up, or the original 50% of the cash, might only have, let's say, not moved, okay? But the share portfolio has increased by 20 grand. Now, all of a sudden, now that is not 50-50. It's now drifted. It's drifted to a more growth-orientated investment. Now, what that means is that portfolio is now taking on more risk than potentially the person needs to take, okay? Also, that the person may tolerate. And so what we look to do is to say, okay, well, in that circumstances, should we, as the word says, rebalance back to the target asset allocation that we first wanted to set up? And in most cases, the answer is yes. Now, the pros of this is that you're not taking on more risk than you should, okay? You're also usually taking profits off the table in regards to these growth-orientated investments and then putting them back into a more defensive assets, reducing risk from the drift itself. But also on the flip side, if that was the reverse, if markets went down and it's now you've only got, I don't know, 30,000 or whatever it is in shares, the cash portion is now even higher, therefore more defensive, and you might move from a 50-50 to a 70% in defensive, 30% in growth. And so what that ends up telling you to do is what the strategy essentially tells you what to do is to then move from cash back into equities, which essentially means that you're then buying shares at a cheaper price than they were. So sometimes what people say is, oh, John, well, then you're timing the market. No, it's a predetermined date that you usually go with, that you want to look roughly, or a particular month that you look to rebalance the portfolios. Sometimes there's significant drifts from major events that happen really, really quickly, and you might need to rebalance in upward markets or in downward markets. But this is really important risk mitigation strategy to ensure that your assets and ultimately the risks that you're taking are in line with what you need to do.
And like with that too, like that was more of a specific portfolio scenario, but even if you have a look at someone holistically and you think about all their money, like okay, someone might have an investment account and they might have money in the bank, and if they've done really well and they've I don't know, maybe earned some pay rises and their savings rate is much higher, their savings in their bank account is probably increased, which is above their asset allocation that we wanted in cash. And we might need to rebalance that and therefore increase the dollar cost averaging into that investment portfolio. So that's where they can both go hand in hand together. Or even you might just make a one-off contribution into that investment to realign your asset allocation accordingly too. So not just from a portfolio point of view, but if you look at your whole life point of view, you can rebalance it in that perspective as well. Can't speak today.
No, all good. And so another question I get asked in regards to rebalancing is how often do we do it? And I would say that like you probably want to do it at least once a year, but also maximum of twice a year. You wouldn't want to do it any more than that. There's a few reasons why. One is that you've got to allow markets to do what markets do. They need time, and 12 months is actually a short period of time in regards to most of these asset classes. But also when you're then selling assets and moving them around, transaction costs, taxes, things like that as well too. So, you know, though, like I said, it's a good strategy, and, you know, the Intelligent Investor, Benjamin Graham's book, even also prescribes this being done, okay, but also not too often as well. So, definitely something that we're looking at every single time, and one of the key essentials in regards to making sure that our clients' goals are met. What else you got there, Ant? What's another one?
Different risk profiles for everyone. Everyone's got a different sort of risk that they're willing to take, and that's something that a tool that we use is assessing people's risk tolerance and what they're willing, how much they're willing to invest, and especially the factors that determine that. Two of the main ones that I see are past experiences, but also where you are in life. I think they're probably the two big factors in how people determine their own risk. And it's very interesting to see after having a bit of a conversation and even some education, how that affects people's risk tolerance and how much risk they're willing to take once they understand a little bit more how the risk is sort of affects them and how it's calculated in their sort of portfolio.
It's interesting. Like, so there's the risk profile is made up of a few different angles, okay? And most people do what they call a risk tolerance questionnaire, which essentially in the name itself is the risk you can tolerate. But as I said before, there's also the risk you need to take, yeah? And so someone might tolerate having all of their money in shares, but that doesn't necessarily mean that they need to take that level of risk. And the biggest contributing factor, like you said about past history and stuff like that, is also knowledge. Yeah, knowledge. So the linkage between risk tolerance and financial literacy is directly correlated.
Yeah, like we see this very early on with clients. A lot of them are a bit hesitant or a bit scared to invest and taking risks, but as they get more exposure and they get some more education after conversations with them one-on-one, and then using education, even listening to podcasts like this, they are a bit more aware of how risk works and how investments work, and it allows them to be able to take on a little bit more risk most of the time because they understand. And when you understand things, you do feel a bit more comfortable.
Yeah, and I kind of put it like this way, like, and do you remember when you first drove your car, like the first time, yeah? You got in, you put on your L plates, you get in the car, and you are absolutely nervous, you're excited, like everything, but like ultimately you're scared, yeah? Like you've never driven a car before. And so, if you're driving manual, I remember you're kangaroo hopping, you don't know which way, a car comes near you and you don't know if you indicate. But now, like after years and years of driving, it feels like second nature, yeah? And you know that the car gets next to you, you swerve a little bit. So, like, it goes to show that, just being aware of, like, driving, like it is with investing, you become more aware and you can take on more risk. But also, if we use the car analogy, let's say that person's an experienced driver, but then unfortunately has a really bad accident, okay? Especially surrounding that accident period, yeah, they will be very cautious. Or maybe the accident that they nearly had, yeah? So rather than the person driving at the speed limit all the time, you just find themselves, their behavior changes and they now start driving at, 5 or 6 kilometers less than the speed limit. And so this is the same thing that happens when you have major shock events, okay? And so what we saw was, especially after things like the global financial crisis or post-COVID, people felt that scar. And so they would then, but as we're interesting as humans, like as time goes by, if we don't learn to understand the behaviors and what's going on in our minds, we sometimes get back to our old ways, and people don't learn. Okay, so what we would like to see is more knowledge in regards to how markets move, what asset classes are. So we're very much around education of our clients, like we do on these podcasts as well. I know a lot of clients listen, but as well to you guys listening and watching. It's not just about us doing the work for them; it's educating them along the way, because as they go through these experiences and see their balances drop and all of these certain things, their emotions are going to try and get the better of them. And you'll see people move up and down the risk scale depending on what's also happening in their life as well. So we need to be very mindful of the circumstances that are happening with the person. We also need to understand what we know about the person and also what they're actually telling us.
And that's also another point, like using the driving analogy. There's also the one where if you can get to where you need to be by driving the speed limit, there's no need to have to speed to get to where you need to get to. Like, the goal of investing is to get to the position you need to be with taking the least risk possible. So if you can get from where you are now to that goal position where you're able to achieve everything you want in life and retire comfortably when you want to retire, there's no need to take that extra risk and go over the top with risk to try get to that position, but you have, I don't know, maybe a little bit extra money that you wouldn't necessarily need either. So it's about also risk mitigation and taking the appropriate level of risk based on your goals and sort of where you are in life too.
Well, for those who know, I was driving a Ferrari this morning, and thank you, Cavallo, especially Haas at Cavallo Prestige, for letting me drive it. It was an amazing experience. But I said to Anth, I've got the car, I'll come visit you, remember? And I looked at the time, and you know what? If I took that car, I would have seen you. Yeah, I would have come to see you. But the reality is did I want to risk it? Was it that important for me? And see, when I look at markets and I look at that decision, yes, you might be ready to go and you might be excited and I want to get to that destination. But if I done 200 clicks coming to see you, I may have not saw you at all. We see that all the time. We see people get excited. Yeah, see people want to fast track a lot of stuff, wanting to get to that destination. Now, there's a lot of people in that circumstances who would have just taken the car and gone fast to get to it, forget about the speed cameras for now and all that stuff, like to actually get there. I see too many people doing that, Anth.
Yeah.
I see too many people fanging it, wanting to get to the destination, whoever that is, and risking it. I'm not doing that because there's so many other things that are important. So relating to other areas in your life hopefully gives you a little bit of understanding about how risk, especially like the risk you're taking with your investments, the effect it's having on you getting to the destination. Now, the longer the timeline, usually the less risk you need to take. So, for example, I was really cutting it fine. So to get there, I needed to really speed. But if I had ample time, I could have came and see you. You know, I would have come and I would have shown you, but I just didn't have the time. Yeah. So I had two choices. And that's what people find themselves. So when I'm speaking to people that are like just before retirement, they sometimes need to take more risk than they can tolerate.
And that's why, like they're saying, like starting as early as possible is always the best, because you've got that time horizon where, all right, you can calculate things a little bit better. We can take a little bit less risk because you've got that time to let things grow. Because the other big one is patience too, especially with investing. It sometimes feels like watching the grass grow, but it requires a lot of patience, and time is really your best friend with investing, because with the power of compounding interest, the more time you have, the more magic you get to see.
I will tell you, it was exhilarating, yeah. But I looked at the price tag and it was pretty crazy. So How your mind as a financial advisor works. But anyway, thank you, Huss, and thanks, Carvalho, for the experience anyway. Correlations. So next one is around there's certain investments that kind of work together when markets move, and there's certain investments that don't move together when markets move. And this is what we call correlation. So for example, to make it very simple, if one asset goes up, which asset goes down, so on and so forth. Now, in most cases, nothing is perfectly correlated. Like usually they say a good correlation is between, say, bonds and shares. Okay, so usually what happens when share prices fall, people rush to the bond market, therefore meaning that bond prices are in demand, and so then bond prices rise. Okay, what we found, especially through the COVID period, is that both bond prices and shares were going down. So they had this double whammy happening. Okay, people have said, for example, like crypto, is like an inflationary hedge. Yeah, so and it's also, for other assets correlates. Correlation is very, very important because if all of your money is in assets that move the same way in every single event, you're going to get potentially wiped out completely. So it's very important to understand how the assets work also in tandem with one another. Okay, because when you're building a portfolio, if you've got an event that could happen that could literally crush everything, what's the probability of that event happening? For example, in inflationary issues, do all of your assets move downwards when inflation happens? If that's the case, well, you know what? Inflation happens pretty regularly. It doesn't have it happens more regularly than people think. But it also might be there's some that you can't. I don't know. If a absolute world war breaks out, it might be only 1 out of your 10 investments do something. For example, traditionally gold, people rush the gold. Yeah. So when we're building portfolios, we're looking at the correlation of these investments as well too, and also how much we can control of that is probably the secondary thing, because there's some certain things that you can't control. Can you control a war? No, you can't, but you can also have some measures in your portfolio to how that responds to that scenario. So talk to a few, Anth. Is there any others that you wanted to, any others that come to mind? I know we've spoken about dollar cost averaging, we've spoken about rebalancing, we've spoken about risk profiles and risk tolerances and how that works from an actual risk perspective, and correlation. I'll probably the only other one that I would probably just double down on is around just behaviour and education.
Yeah, and I think one of the big ones is patience.
Yeah.
I know a lot of people, when they start investing, they have a bit of ants in their pants where they just want to go hard, they want to get everything going, but then when investments are going good, everyone's talking about their investments. But when things start to go bad, it can scare a lot of people. So what usually happens when people start out investing, like they start investing, investments growing, it's doing really great. They want to keep putting more money. But as soon as that starts to come down, they get really scared and they want to sell everything. So it's about finding that right balance, not going too hard, being able to emotionally work through market cycles. That's something that's really, really important emotionally.
Yeah, definitely. I think being patient, understanding your emotions, okay, and that they will play havoc on you and you need to improve those. And I think the other one, Anthony, just understanding that risk is in everything, okay? Both the behavioral risks that come, but also the financial risks as well too. And so, there's been a lot of generations now that have not had a real blemish. Like, I'll be honest with you, if you're born like in the 1990s onwards, you really haven't seen a serious crash. And people are going to go, oh, John, well, what about, listen, COVID was a V-shaped recovery where tons of money came into the market. It was probably behaviorally one of the worst things that could ever happen to someone, because you saw your money come down and then miraculously go straight back up and then skyrocket after that point. If you look at like that in combination to like what happened on the ASX 200 versus like what happened in the global financial crisis, to get back to the same level on the ASX 200, I think was 11 years.
And do you think because people saw that the market...
Sorry, so I think it was I'll take one before you continue. I think it was like 9 years before it came back. But anyway, yeah.
And do you think because of that, people, I don't know, now that people have seen that, okay, they know, okay, after the GFC, our money ended up coming back. It took a little while, but it got there. Do you think that gives people a bit more confidence that if there was a crash again, that they're a little bit more confident that that money is going to recover?
Yeah, and that's the problem you've got. It's like, all right, shit's hit the fan. Government's going to come in and print money again. Well, cool, but that's an inflationary problem. Inflation is the biggest hidden tax that people have. Most people understand that the rich are getting richer and the poor are getting poorer. So the separation between the middle class happens from inflation. Okay, so and you want to see it, let's think about when the printing of the money happened and then Elon Musk and Jeff Bezos and Richard Branson are playing space cowboys. Do you know how much it costs to get a rocket up into the sky and these guys are just shooting them up? Bezos just sends his missus and a few of his girls with him and they go up in a rocket. Like it's the difference between the rich and the poor cannot be further apart. And in inflationary times, that gets even worse and worse and worse and worse and worse. So, and that is like, I think we're talking about, I'm pretty sure the number is like the US printed $5 trillion. Crazy. Now you look at the wealth of Bezos and all of the Forbes top 100, their wealth pre and post COVID. And then you look at the lower socioeconomic stats, you look at the middle class stats and see what happened. So even though people in those times go, just stop the pain, stop the pain, stop the pain. You know what I mean? Like if your hand hurts, it's like crushing your foot. So that the pain in the hand doesn't feel bad, but you crushed your foot. You know what I mean? So behaviorally, that event was really, really bad for people's knowledge and people's understanding. And like I said, if you're 1990s onwards, you don't understand the GFC. Even like if you're in your late 80s, in this late 80s born, you don't feel it. Like for me, I understood it. I felt it. I got into the industry in 2003. So 2003, I still remember going to my cousin's financial advisory practice on the table in the kitchen where we had our lunch. And I remember like war in Iraq. And I'm like, wow, this is pretty crazy, yeah? And I was like, what happens in these times? And it's like, these have all happened before. We'll get through. And like he was educating me along the way. And then we already at that time had September 11, so I was learning about that stuff. And then, when 2009 came about, bottom of the market, 2008-9, it kind of came over the shoulder. GFC happened. It was pretty crazy, yeah. Like, you saw Lehman Brothers, like, fall over. That was, like, huge event. And then the ripple effect onto what that was doing in housing in America, and then what the world was considering at that point in time. The economic might, the financial world of the US was crumbling. And then to see what that was doing to people, for those who understand what I'm going through or talking about, and that saw that, a lot of people are still traumatized by that today. So those events, like you were speaking about before, Anthony, that when you talk about like your prehistory and then what that means, yes, it's true. So people just need to be aware of it. People need to understand it. And that's why your behavior, your history, your mindset, it has an influence. And that's why we try to educate as much as possible so that we can get better at it. I think I'm going to wrap it up there. Thanks, Anth, for jumping on. Thanks, everyone, for listening. If you're loving these episodes, make sure you like and subscribe on all major channels, YouTube, Spotify, Google Play, Apple Music, and share and like to all of your friends as well too. Make sure they're loving it too, because I know most people are. The feedback I've been getting is amazing. So thank you. Appreciate it.
Thanks, guys.